All right, welcome everybody. I'm David Grossman. It's nice to see you all here. We have a good turnout. Let's make sure that's working. Yes, it is. Okay, very good. Great to see you all here on the Saturday morning. Bright and early, 10 a.m. Some consider that to be early. Well, the show's just getting started, so appreciate that you all made it here. As it says, I am David Grossman. I've been in the mortgage business now for 15 years. They have to update my photo in the book and the description. I've been doing this show for a while, for several years. And the topic is outside the box mortgage lending, all about mortgages and leveraged investing, okay? Because that's a question that comes up as well. Should we be borrowing money to invest? So I'll talk a little bit about that. So help keep me on track. We want to get to that. I'm going to pass around these forms now, just because at the end people are running. And so if you don't mind just passing those around, I'd really appreciate it. If you have specific feedback, appreciate if you could share it. And also, if you do want to talk to me, I have business cards here. You can take my card, or if you want to put in your contact information on the form and just let me know when I should call you, I can also give you a call. I'm going to be here today, sort of in the back, sort of in the room next to where the microphone is, because I'm also going to be working the microphone. They have me doing two jobs. I'm also going to be announcing the other speakers as well. So that's what's happening. So we have 30 minutes. I've been a mortgage agent for 15 years. I got licensed as a broker in August, and so at that point I created my own branding, which is Rock Your Mortgage. The brokerage is still Real Mortgage Associates. We're based out of Hamilton. I rarely go there. I'm in Toronto. I spend most of my time in the Thornhill area, but I am mobile and my cell phone is on the card, so I take calls anytime if people have questions about mortgages. So that's the main message there. So first of all, before we get into outside the box, I'm just going to talk to you a little bit about like inside the box. Let's square away some basics. I'm not going to spend too much time on this, but I think it's important to cover some of the basics. So minimum down payment on a mortgage is 5%, okay? And that's an insured mortgage, right? It's insured by either CMHC or Genworth or one of the insurers. There's no benefit to, there's so many different kinds of insurance. People who wouldn't. There's no benefit to you to having an insured mortgage. The benefit is to the lender. It protects the lenders against losses, but it's just the law. And in the rules in Canada is that when you have less than 20% down, mortgage has to be insured. That's just the way it is. Okay, so it's 5% down on the first 500,000, and then 10% on the balance, and the property can be up to $1 million. After $1 million, it's not insurable, which means you have to have at least 20% down. Okay, right? Okay, you're allowed to have two. Hi, welcome. Come on in. Have a seat anywhere. You can come front wherever you like. You're allowed to have two, owner occupied. So you can have two, you can buy two properties with 5% down, but you have to be able to qualify and carry. You can't use rental income into the equation, right? Sometimes you buy rental properties, a second property, let's say it's a rental. Hi, welcome, have a seat. You can use the income from that rental property to help offset the mortgage cost. Well, you can't do that if you're doing it 5% down, but you're welcome. Come on, have a seat anywhere you like your seats here, okay? But you can get two of these, okay? Residential properties, two per person, okay? As I said, $1 million the maximum purchase price, and there's mortgage insurance that's payable on it, right? So there's a whole scale, right? So the smaller the down payment, the bigger the premium. So with a 5% down mortgage, there's a 4.5% loan premium, and that's added to the mortgage, right? So if your mortgage is $500,000, it's, approximately $21,000 or thereabouts. Which is not a small amount of money, but if you don't have to pay it out of your pocket on the closing, it's added to the mortgage, right? It's capitalized. Investment properties, you have to have 20% down. That's the rules. Okay, there used to be 0. I remember doing investment properties, a very small down payment a number of years ago. That's changed. Okay, you need 20% down. Newcomers from 5% to 10% down. This is interesting. Slightly outside the box. This is, but you have to have provable income. So this is for people, they come from another country and they come here and they have jobs. Let's say they're transferred by their employer. Okay, so a lot of times people have problems. They say they want to come, they move here. Well, if they don't have a job, you need to have 35% down. It's still possible to get a mortgage with no job if you have 35%, but you have to have like 3 years worth of principal, interest, and taxes sitting in the bank account. That's what 35% is. Welcome, come on in if you want. You can sit up anywhere you like, okay? I don't bite hard. Purchase plus improvements, that's another program that a lot of people don't know about, okay? And that is basically if the house needs work, welcome, come on in, squeeze up a little bit. Holy cow, they're coming in here. Okay, come on in, come on in. Okay, purchase plus improvements, you buy a property and you arrange at the time of the purchase that, there's a few more seats here if you want to come up. You arrange at the time of the purchase that you're going to do a certain amount of work, okay, and that money's held at the lawyer's office and beyond the purchase price. So you could do 95% financing, right? But in addition to that, there could be, let's say you want to do $30,000, $40,000 work in the house. You get quotes, you submit that at the time of purchase, okay, and then you complete the work, and then the money's released to you. So you can get that all sort of part and parcel with your purchase, which is kind of neat. Okay, a couple more things. Bank lending requirements. Okay, so what is the bank looking for? If your salary, typically it's a job letter and a pay stub. Okay, sometimes they want. They might ask for a tax return here or there, or if you've been on the job for less than a year, but essentially that's what they're looking for. If you're self-employed, the bank is looking for 2 years notice of assessments and tax returns. Again, this is inside the box lending, okay? So to draw a comparison, we'll get to in a moment to see what's outside the box, what we can do, especially for self-employed, because that's huge. 600 Beacon score. There are a couple more seats if you want to come up, welcome. Okay, 600 Beacon score is the minimum one of the applicants has to have if it's a bank type of mortgage. There are exceptions to that, but this means you have to have decent credit, okay, to get a bank type of mortgage. Okay, no more, question?
Beacon score is the same as your credit?
No.
Yeah, Beacon score is basically a credit score.
No, it's not.
No?
No, it's not. The Beacon score is from the bank. The credit score can vary between TransUnion, Equifax, and the other couple of other ones that you have. Your credit score can be anywhere from 600 to 900. Your Beacon score is only found at the bank.
Ma'am, I've been doing mortgages for a long time.
Marketplace last week.
Marketplace what?
It's a TV show that informs people.
Okay, so I pull, when I arrange mortgages for people,
Yeah.
the first thing we do, well, not always, but generally, when we want to know the credit, we pull an Equifax report. And that report has, among other things, it has a Beacon score, which in my opinion is the same thing as a credit score, Beacon score, some call it a FICO score.
Right.
Okay, you can call it whatever you want. Some banks use TransUnion. It happens from time to time that the score on a TransUnion report can be significantly different than Equifax. It happens, but most lenders use Equifax. And I will say that it's not only the score that matters. They're looking at, like, to get a bankable mortgage, they want a minimum 2-year history, and at least a couple of active trade lines for that time, and they should be running clean, obviously, okay? So listen, you know, there's no, like, there could be some semantics here, you know, heard in the US, they call it FICO, whatever. Anyway, it's a credit score. As far as I'm concerned, it's the Beacon score, okay? But again, it's not the only thing that matters when you're looking at credit. Was there a question back here?
I was just asking what she thought the Beacon score was, but I understand.
Okay, fair enough. So let's move on. No insured refis, that's changed. So if you have less than 20% equity in the property, it cannot be insured. You can't refinance that property with the bank anymore. Okay. Limit to the number of the property. So it varies from one bank to the next. Scotia says they'll allow 10 max. But again, you have to be able to qualify. So not a lot of people are going to qualify for that mortgage, for that many mortgages. But with a bank, that is. So, okay, so now let's get into outside the box, right? That's why you're here.
Sorry,
So-
hi, could I ask a question, please?
Yes, sure.
Regarding the refi,
Yes.
if you're not working, can you refi still?
If you're not working, if there's no income in the house and you want to do an equity takeout, we can arrange that. It will almost certainly be through private lender. Okay, and it has to make sense, right? Because anybody who lends money, even a private, they're going to want to know what's the plan, what's the exit strategy.
Not like you're on EI, because if you're on disability and you're on EI, it's like.
Okay, so we can use disability and, well, I mean, EI is hopefully temporary, right? Hopefully you're going to land on your feet, but and that'll change. But we do use various types. You know, we can use disability if it's permanent. Okay, and EI, well, it depends on the EI, you know, like, so, but basically, if you're pulling out equity, so, like, to purchase a property, I mean, if
Yes.
there's enough income, we can get you a mortgage.
Okay.
Okay,
yeah,
but the rule of thumb is this, okay, the rule of thumb is approximately 4 to 5 times your income is what you're going to qualify for, okay? So if you're making, if the family household income, let's say, is about $100,000, ballpark, you're going to qualify for a mortgage between $400,000 and $500,000. Okay, just to keep that in mind. Now, where it becomes questionable is where self-employed people are concerned, and that's a very big niche for me as an outside-the-box type of lender. Okay, I specialize in alternative lending. Right? I don't like competing with the banks. It's not fun to compete with banks. They have very deep pockets. And generally speaking, from my experience, people who qualify at the bank are usually looking just for the best rate. Okay? Now, there's a service aspect to it as well, because you know, it's hit and miss, right? You might. So I've had people come to me. The banks has said to them, "No problem. You're going to qualify for this. You know, it's a pre-approval situation. No problem, you're going to qualify, right? Person goes out, buys a property, let's say on the weekend. Monday comes, oh, the guy's in a meeting. Tuesday, he's off sick. Wednesday, he's in a review with his manager. By the time, and then finally Thursday night, they get back to him and they said, "Sir, you don't qualify. We made a mistake. Well, you're actually self-employed, and we didn't realize it, so you're not qualifying for the mortgage." So this is actually a true story. And then, so they called me on the Thursday night, and I got them the mortgage on the Friday in one day, right? But we recognized what it was. So that, you know, there's a service aspect to it too. So I do what they call prime lending or A mortgages, and I'm happy to do it, no problem. You'll get good service, okay? Because I'm experienced, I'm not going to tell you something that's not true. But you know, the reality is that one day I've got a better rate, the next day the bank. So there's, you know, there's mortgage brokers out there just saying, well, we have all kinds of lenders to choose from, so we can always. I think in any business, as it's a good rule, is that unless you're Walmart, like, you don't want to be competing on price. You want to establish some kind of a niche. Okay, so that's what I've done. Is I've established a niche in outside-the-box lending, because a lot of people, for different reasons, are not getting what they want from the bank. Okay, they could be self-employed, they could be property investors who have multiple properties, they could be builders, they need construction loans, they may have credit issues, and you go to the bank, and you know what it's like when you go to the bank. You wait here, you wait there, and then the person doesn't know, then it takes a week to get a call back, right? You call me, I'll tell you within a few minutes if we have a chance, or to get you and roughly what you're gonna be looking at. And then if we proceed, I'll keep you informed all the way, and so you'll know what's going on. I don't play games, okay? So let's get down to it. Self-employed. The biggest thing with self-employed is simply this, okay? Self-employed people are often going to be minimizing what they report for tax purposes, because that's, that's one of the things about being, that's just the way it is, right? You can write off certain things. So, I'll give you an example. Real estate agent making $250,000 a year in commission, reporting net income of $65,000, right? All kinds of expenses, right? Now, I don't work for Revenue Canada, and I'm not his accountant, so I'm not gonna say whether those expenses are legitimate or not. That's not my job, and it's not the job of my lenders. There are institutional lenders out there, okay, many of them, who specialize as well in this niche market of alternative lending. And they've been around for decades. And they know that that's what self-employed people do. But for some reason, when you go to the bank, Rick, hello, when you go to the bank, still, as a self-employed person, the first thing the bank says is, I want to see 2 years tax returns and notice of assessments. So you go in there, Mr. Real Estate Agent shows him the tax returns, $250,000 in sales, $65,000. Okay, sir, you're making $65,000 a year. Great, you're going to qualify for a mortgage of $250,000. That's $250,000. What kind of property am I going to get for $250,000? Our lenders, we don't ask for the tax returns, notice of assessment. We start from the top line, okay? Real estate agents making $250,000 a year. What's reasonable expenses for a real estate agent? Maybe $20,000, $25,000 a year. Okay, sir, we're going to assume you make 2 1/4. So using my rule of thumb calculation before, with 2 1/4, person could potentially qualify for $1 million or more. Okay, that's more like it. You can get somewhere with $1 million mortgage. 20% down required. Question?
Would that be the case even if the 250,000 is to like a corporation that just the real estate agent or maybe the agent with the white homes?
Yes, good question. Okay, so, but the expenses have to be reasonable, right? So if you have like a ton of employees, but again, like they don't come in and they don't do an audit. And guess what? I don't ask for your financial statements either. We work mainly from bank statements. Okay, so as long as you're 100% owner of the corporation, and if you're not 100% owner, that's fine. If you have a partner and you're 50% owner, we'll use half. Okay, so but again, we do it off the top line. So your corporation may be making $1 million a year, right? Producing I don't know what. Then we say, okay, so maybe your expenses are 200,000 or 300 or whatever, even $500,000. Bam. We're working off $500,000 of income. So you can go a long way with that kind of income, okay? In terms of qualifying for mortgages. Yes, you will pay it a little bit more, okay? So you're gonna pay, to start, you're looking at approximately 4% rate, okay? And it goes up from there. It could be a little bit higher if it's an investment property or a refinance as opposed to a purchase. But, and the other thing is though, it's going to be on, it can be on, and usually is, on a 30-year amortization versus 25 years. So you pay a little bit higher rate, but from a monthly cash flow standpoint, it keeps the payment under control. And guess what? If you're making that kind of money anyway, you're just happy, you don't care, you'll pay a little bit more on the rate, okay? If you can get the mortgage that you want. Okay, and this is whether it's property for your own use, or whether it's rental property, okay? So if you're in a situation, or you know somebody in a situation, and they're not getting what they want from the bank, great opportunity. Some people call it B-lending, okay? I don't like the term B-lending because it suggests that you are not an A client. You're not a great client. And a lot of the borrowers that we deal with, some of them, not all of them, are very strong clients. So that's why we call it alternative lending. Hi, welcome. I don't know if there's any more seats. Sorry if there's not enough seats, but anyway, welcome. Did you have a question or are you just waving? Hello. Hi. Okay.
And what's the minimum down on this?
20% down, okay? Because to get around those normal guidelines of the bank, it cannot be insured, because if you have less than 20% down, it's gotta be insured, and guess what? The CMHC, Genworth, they follow the same thing as the bank. So as soon as you got that 20% down, or 20% equity for a refinance, there's a lot more flexibility in terms of how we can treat the income and such. Rental properties, okay, that's another way. I don't want to get into a lot of discussion about it, but the basic thing is this, is that typically you go to the bank, you have rental income from a rental property. Bank says, okay, we're gonna take that income and we're gonna add half of that income to your income. And that's how we're gonna, I'll tell you, if you sit down and work it out with a pen and a paper, it does not get you very far. Okay, so they're not especially generous when it comes to how they use rental income. Whereas these alternative lenders that we deal with, they do what's called offset. So they're gonna offset with rental income against the expenses on the property, mortgage expenses and taxes. And it's good, bottom line is it's gonna go a lot further. So we have people, a lot of people that I deal with, they come to me, they've got 3 properties, 5, 10, and they've maxed out and they say, we wanna keep on going, can you help us? So usually in those cases, we can help them. The lenders do like when you have a regular job, okay? In the residential marketplace, so this is 4 units and below, okay? 4 residential units and below. Lenders, all the lenders, even the alternatives, they do ask a lot of questions. They want to know, what's your personal story? You have income, so they're going to look at your own income. And they do like it when you have your own income. Now, when you get into commercial is considered 5 units and above. Okay, so even what they call multi-residential. Okay, so 5 apartment units, right? It's all in residential apartments, but it's a different product. Okay, and the lenders we go to, they look at it differently, and they look at it and they say they care less about your own personal income. So 4 units and below, they're very all the lenders. It's got the right PDS, GDS, if you know those debt service, everything expensive, but we have the flexibility with the alternative lenders. But I'm just telling you that if you want to get into a different product category, 5 units and above, it's the underwriting is quite different. Yes, sir.
So what about if you have, for example, like triplex in commercial zone?
Like what do you mean commercial zone? Are they residential units? Are they
Residential units in commercial, like close to plaza or something like
okay,
that?
well, if they're residential units, then it's a residential property. So as far as I can see. So again, it still falls into the first category.
So the mortgage, it can be like pre-approved as like a commercial or as residential?
That would be residential because it's 4 units and below. So that would be residential. But as soon as you add a commercial component to it, like a store and apartment, where maybe you have a retail store, for example, on the main floor, 1, 2, 3 apartments, a residential apartment, that's a commercial product. Okay, that's a commercial product for your information. Okay, but we have loan options for that too. Institutional loan options. We can always go private. Okay, but long-term private money is expensive. Private money is usually to get you over some kind of a hump, whether it's construction or short-term financing with an exit plan, because it's expensive to carry. Did you have a question?
Yeah, so you said that they care less about personal income from commercial, so what's the most important thing they care about?
Okay, so the most important thing is the income of the actual property itself. Okay, and what is your plan for the property? So this is also a good example of inside the box versus outside the box, right? Because with inside the box, you go to the bank, okay, and you say, okay, here's a commercial property I'd like to purchase. Okay, well, what's the, show us the rent, show us the income schedule. Okay, they work it out and they say, okay, this is how much we're gonna lend you. And maybe it ends up coming out to like 50% of the value. And they're basing that figure based on the income of the property. And you say, yeah, but this is an underperforming asset. I mean, the reason we wanna buy it is because we know we can make certain improvements to the property. This guy's paying way under market, we think we can get him out, we think maybe we can add an extra unit in the back and get some income there, and maybe renovate, put a little bit of money into here, and you know, improve it. And they're like, well, yeah, but, you know, okay, 5-minute warning. They're like, okay, but that's what the, you know, so that's inside, so it's outside the box lending. The lenders are gonna say, okay, well, what's your plan? Have you ever done this before? Oh, you've renovated, now give me a few examples. You bought a property for X amount of dollars. Tell me what the, you know, we need to know something about your experience, right? You've done it a couple times before, you look like you've got some experience, you know, okay, so we'll give you a higher loan to value. Might charge you a little bit higher rate, maybe we'll charge you 5% instead of 3%, but you can get in and get a decent mortgage, and then once you improve all the rents, then if you want, you can go back to the bank after, right? But if you want a decent loan amount, may have to look to alternatives. Questions?
So you say that you're gonna look at a plan. What kind of plan? Is this a business plan you have to prepare?
You don't have to do a big plan, okay? But simply, like I said, you say, okay, this guy, it is not that difficult to see. This guy's paying under market here. We're gonna add an extra suite in the back. The property hasn't been renovated in years, so we can increase this. So just a few things that say how you're gonna add value to the property. And if you've had some experience, or somebody that you're working with has experience, and you've done this before, and you can show a few examples, then you'll be able to get more money. Okay? All right. So we've only got a few minutes, so I'm gonna get down to, yeah. So alternative lenders, there's no minimum beacon score for credit score, whatever, for most of them. You can do it even right after discharge of a bankruptcy. Okay, as long as you've got the income. So the rule of thumb is this: alternative lenders, okay, we're like institutional lenders, okay? That's something you can carry long term. You know, 4 or 5%, sometimes maybe 5.5%, even depends on exactly what's going on. That's something you can carry. Private money is usually meant as a bridge, something short term, okay? Help you out of a bind, but there needs to be an exit, right? Because it's expensive to carry. But even sometimes you buy a property, maybe there's no tenants in it, right? And the place is a complete disaster, and no institution will want a loan on it. It does happen, right? It does happen. You can get private money for something like that, and then, you know, 6 months or a year later, once you've done what you need to do to the property and you've tenanted it, then you can get more traditional, some kind of institutional finance.
What are private money rates at about?
Private money starts probably at around 6 to 7% for a first mortgage, and it goes up from there. You know, depends on whether it's a first or a second, and then there's fees too, right? Yeah. Questions? Because we're almost out of time, so if there's something somebody wants to ask. Of course, I'm around all day. I'm around, so, you know, by all means, you can talk to me anytime about if you have other questions or you want to discuss your situation with me. My cards are here. Grab a card. Again, I passed out some forms. So I would appreciate feedback, and if you want me to call you, just put in there your information. Ma'am, you have a question? Yes.
Your institution, do you guys do any US lending for US property?
No, I don't do U.S. lending per se. I know good. Thank you, sir. I know a good mortgage broker in Florida, but I don't do U.S. lending. So some people take out equity in order to buy properties in other countries. We can do that, but no, I am licensed to arrange mortgages here in Ontario. So anywhere in Ontario, I can help you out with purchase or refinance, first or second mortgage, residential or commercial. Thank you, ma'am. Yes. Any other questions? Okay. Let me just see if there's anything really important. Construction. Again, it's your level of experience, okay, is important. If you want to build a house, Okay, well, have you ever done it before? Or if you've never done it before and you wanna try it, that's fine, okay? But, you know, you need to have somebody, you show that you've got somebody on your team who's gonna help you, who knows what they're doing, right? One interesting thing is that with some of our lenders, this is outside the box again compared to inside the box, is they're gonna lend based on the completed value as opposed to, as a percentage of completed value, as opposed to a percentage of cost, okay? Because the banks typically will say, okay, we're gonna lend as a percentage of cost. So, you know, you're gonna spend $100, we'll finance, let's say 80% of that, and you put in $20 of your own money. Well, let's say you have a crackerjack construction team and access to really good trades and low-cost materials. We have lenders that will say, okay, we'll lend based as a percentage of completed value. So let's say 80% of completed value. So you just get the appraiser to come in after you've done some work. Appraiser says, okay, the project is now 50% complete. So they're gonna release funds based on the completed value. So it's theoretically possible that you don't even have to put any cash in if you're, you know, like I say, if you got access to really good trades and so forth. Any other questions? Okay, so I was given the wrap-up signal. What time is it? It's time to wrap up? Okay. Okay, so it's time to wrap up. So again, thank you all very much for coming. Have an amazing day, and please stop by and say hi if you were inclined to do so. Thank you. Thanks a lot. How are you? Hi. Okay, so please do, you know, if you're around today, we can chat, or by all means, reach out and have interest in where we're going. Yeah, whatever. Okay, good. Hi. Yes. Insure two insured loans. Hello. Yes. Yeah, well, you have to qualify. So you have to qualify for two on your own. As long as you qualify for two on your own, you can qualify for two on your own, then if he buys a couple, no, it's a very good point. Then why, you know, and your plan is to buy real estate, and you're trying, you're trying not to sell for necessary, because now you have to dispose of it. Yeah. Even though both may be completely, each of you is considered 100% responsible for each mortgage. So yeah, it's a good point. Maybe one of you could come on. If you know, that's talk to her. Yeah. Right. Yeah. Yes. Okay, so I ran out of yeah, I had they all disappeared, but I have more at my desk. You want to come over? At my booth, yes. You want to come over? Okay, please do. Yeah, I appreciate that. Okay, good. Yeah, fine for now. Grab them right now. Okay. Too.
Yes,
That's okay, man. You know what?
Because on Marketplace, they had it on Marketplace.
Yeah.
And they were showing you that it's going on 4 pages.
Like my friend of ours is, like I
Yes.
actually like brother father-in-law,
Yes,
like he's a slice.
And he said,
Every day,
So,
every day,
like,
just
yeah,
a
my
slice.
cousin's son too, every day.
And so, then you're actually in general class. So I thought that was interesting.
encourage it.
And you have to start there, or else you're gonna.
Exactly.
I mean, I would say that,
What's university issue?
She went to
there,
work for 4
I don't
years
think
and then
they're
she went to
useless,
West
but
Point for teacher's college.
someone
So she
follows
did
the
that.
guidelines,
Yeah.
and say, this is the minimum, has to be over this much, or we're not.
Right, so my
considering
son
you.
is in grade 12.
But
No,
I will
They're
say
gonna commute.
that
But it's better
what is
because-
definitely, much
No,
more
she takes the
important than the
407
actual score.
every day, right?
Is what
And
is
it's
going
half
on
an
What
hour.
area you live
credit, right? Because the
Oh,
lenders,
yes.
the
Yeah,
lenders
so
want to
400,
see,
407.
how many trade lines do you have? What's the limit on those trade lines? How long have you had them for? What is your utilization of it? So for example, you have a
When did you guys
$10,000 credit card and
Get it?
you have outstanding balance
You guys
of,
wouldn't mind
$9,000. Then the lender.
Jenny just did this year too.
Yeah, that's right.
Like, why are they mad?
Nice, do you guys still go fishing and all that
No,
stuff?
no, like I
If
don't
you
do
miss
that. Like I
payments,
see once in a
yeah.
while.
Well,
Yeah.
right,
College.
so definitely, credit score
Yeah, that's nice.
is,
How's Frank doing?
He's doing all right.
definitely not the
Yeah.
only thing,
He's
but,
living with Rich.
Oh, good for
it
him.
is more important what is actually going on, and the lenders do
He
look
takes
at
the
that,
407
but
too.
with banks and,
They go
with
to the
banks, they
407.
do have certain minimums
They
where
can
they'll
go
just
home
say,
and
They get the bill, and I get the bill.
your credit score is
Crazy.
6, or
No, no.
it's just special programs sometimes where you need 680,
No.
okay?
And you
A certain bank
It's
says,
not
hey,
big.
you know, it's a really good rate,
That
or
part
really
of
good,
it,
it has
everything
to
else
go to
she pays
680
except
or
the
even
car stuff, because
720,
you know
like
what,
really,
she has
really
like a
high.
little bit of anxiety.
And if you don't,
So
you don't
I
have that
can't like,
threshold,
but
then
Too much on your watch.
you gotta really, you gotta like, a little bit, the baby steps right
yeah, but anyway, so you mentioned that you had,
That would be different if she didn't like working. Yeah.
you had a question or whatever, so I'd be happy to chat with you anytime.
And you can appeal the.
Okay, so you'll come over, okay, that would be great. I'm sorry, what's your name? Mary, hi
So I just
Mary.
came.
Yeah, nice to meet you, sir. Bob, very nice to meet you both. Yeah. Okay, good. See you later. Hi. Sure. Your permanent residence, okay?
How to invest during rental prices.
Yes.
Oh, that's good now. Harry's here. Nothing, so September divide. 15 minutes here.
That's how we walk into this.
Other place.
I just want to know the opportunity
I'm not going to want.
because our plan is not to stick to one house. We are investment and we are investment.
Right.
Seriously?
So we want to buy one, to buy two, and to make
Yeah, I've heard
money.
right across the
Yeah,
board.
and you went on
both
a
sides.
Mine?
Both ends.
No, the first one is
Amazing.
And then where are the rental apartment, where are the rental?
on the floor, and then we do better for upstairs. So this is okay. So by next year, when it will be sold, we have for tax purposes, we have some
And the
income
cash flow,
on
how
that.
if you've got a good
So
cash
when
flow.
will the renovation
Yeah,
be finished?
like I can't.
By the end of the month,
Yeah.
then
Well,
now
yeah.
it's
The value
quite,
is-
Is where I
yes,
am.
so we didn't expect much.
So it's almost like so much.
It's been mortgage, so it was a very good day to buy.
This year? You deal with that? We're not fine. He's busy, man.
35? Yeah, so that's the best you can get at this point in time. Right, so what's the question?
My question is, what's
Is he an
next?
electrician, right?
Yes.
Because
Master
I
electrician.
think that we can go to two new commercial homes, buy
Yeah.
two property on the end. But after that, what do we know that? So most of the lenders, most of the bank look for income.
Yeah.
We do not intend to. We are suffering, we are not, at our age, we are not going to go and sit in and just we will be running.
These people who are smart, Aaron inherited.
And that's why
They have those
it's even less money than what it is.
Right,
Yeah.
yeah, okay. Hi, how are you? Good to see you. Okay, so, yeah, just good, thank you, I appreciate that.
So what do they look at?
Well, they're gonna wanna see, you're gonna have to show some income somewhere, so even if the hospitality is
Yeah.
generating income.
This is our time though, of like, we have all the energy now, so we can just push it all out there.
Can show.
Effectively, How old are your kids?
Gabrielle is 20 and 7
Yeah,
is 27.
okay, so, but
Gabrielle's-
leaders generally
Gabrielle's
are
third year
not,
university.
today, they're not
What does she
really
take?
based on.
She wants to be a speech language pathologist.
Okay, like you said, there's
That's
the
really
amount
good, you know what,
to there.
there's a lot of demand for that.
So beyond that, you're gonna wanna see.
Yeah, there is.
So,
No, really, like, because
if you want
the referred, right, so it's government money too, right? There's
So
some
if you
private
can show
ones.
good income for
Yeah.
hospitality, there's
But
also
they-
like future
hospitals,
property, you want to
yeah.
have like
And
standard
what is
rentals
your
or.
son or?
No, two girls.
Two girls.
And Emily's in grade 12.
Right.
She has
So,
We want to do that as well.
That's my son, I'm going out of my mind, he's in grade
Right,
12.
okay, well, you know, listen, if you have a good
17%,
equity
it's the same age as my son
and you
Joshua.
can show that,
Like it's,
that you
quite
have
crazy.
some
Her,
rental
easy.
income, then
I
That's
know
okay.
what she wanted, we knew what
There was nothing to
to help you grow, if you want to just continue beyond that, I think.
just anything, right? So
So
where
she does wanna stay home, you know that.
Yeah,
it would be
same.
possible
She's
to
thinking
do something,
now,
right, you might.
well, how much for the year.
Same.
Payment.
Oh my God, social media? Yes, media studies. Same, my son. Well, Humber, Etobicoke, right?
Yeah.
Yeah, so like, they came to the school, first he was like on the fence, Ryerson, just there, whatever. Exactly, the film studies, was your daughter gonna do photography or film at Ryerson? Yeah, my son would have done film, but I said, crazy, you
Well,
would
the other
commit
thing
yourself for
is maybe
4
you
years
should
to
look at
something you don't even know if you wanna do anymore. Out of your mind, like, let's think about this.
And then they're gonna be, just gonna turn off the cameras, and then they're gonna be less concerned about your own income.
Right, that's better. You know what you wanna do.
Right?